What's up? I'm Dan Fredenberg, and this is another Chance Encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon.
I understand that there are power lines that are getting kind of close.
What's up again? This is Dan Fredenberg, and that there is a commercial real estate building.
I'm joined today with Martin Kenny. How you doing today, Martin?
Good. How are you?
I'm fantastic, and I got some great news for you, Martin. I don't know if you realize this or not, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors, that means lenders, buyers, sellers, operators, all that kind of stuff. And you may ask yourself, why would you do that? And the answer is, if you've ever heard of off-market deals, they're the private ones that you're not allowed to publicly discuss, you'd know that the SEC requires in a 506B syndication that you have documentation of your prior substantive relationship, or else they'll get ants in their pants. And we definitely don't want that. It turns into a house of cards. It's just bad news overall. So I have people on here, and the benefit for you watching is you will learn how to more effectively communicate on the subject of commercial real estate deals and understand how my guest fits into those deals. Now, before we get too excited though, Martin, do you want to say a thing or two about yourself?
Yeah, it looks like the most important thing is just that Dan and I met at an event in Phoenix earlier this year, and that's actually what led to this scheduled call. So that's probably the best thing to mention.
It really is, because after all, that's why I call it chance encounters. It's a little bit of a tongue in cheek, a wink to the SEC. It's like, okay, so you're not supposed to entice investors if you're involved in private deals, but somehow you're supposed to meet them. So that's what I do. Is when I meet somebody, I have them on here, and I talk about things like the 5 distinct motivations. That's the first segment inside this interview series. But before we do that, I gotta say, but wait, check your 8. Martin, you're on the younger side, so I don't know how good you are with technology, but maybe you can see through the camera, and down in the user's device there might be this hideous subscribe button, and maybe they want to do something. It's ugly. Okay, it's a dumb joke, but whatever. I do it in every episode. The 5 distinct motivations. I've now spoken to hundreds of different players in this sector, and everybody has their own unique why for why they continue to do these different deals, but I found they fit pretty neatly into these 5 different categories. And it's important for us to know each other's motivations, because after all, these deals take months to close. They take years to go full cycle. So we need to know what exactly is going to keep somebody from throwing in the towel. And these are the 5 that I've been able to find. The first one: preservation of purchasing power. What's that? Well, some people, they are job optional, so they don't have to work for money. The way that they pay their bills then is from the proceeds of ownership. In other words, they have a portfolio of assets, and the profits that come from those are how they pay the bills. And you might say, well, if somebody doesn't have to work for money, why would they bother going through the hassle of another acquisition? And there were a few different circumstances for that. The first one is if inflation is rearing its ugly head, that's going to eat away from the purchasing power of your cash flow. So it'll be time to make another acquisition. But the other times are when there's an asset crash or serious distress in the property. And so that way you can buy at a steep discount. Now, of course, regardless of the economic climate, you still should be buying at steep discounts or not at all. That's very true. But those are the reasons why people in this situation would make an acquisition. And full disclosure, I'm not there yet. I'm not that far into my commercial real estate journey. So what I'm up to is trading time directly for wealth. And to fence that in a little bit, my background's in technology. Specifically, it's in the CRM industry. So I was running a CRM agency that I founded back in 2011, and I didn't make the jump onto into doing that for real estate until 2014. The guy I was doing it for 6 years, he was flipping 10 houses a month, every single month for years before he ended up hiring me. And as I saw not only how much he was making, but also the fact that his tax burden was way more advantaged than mine, it hit me to go, I really need to pivot where I'm getting rewarded for my efforts in the form of deployed capital, these little slivers of equity, instead of a higher and higher salary. So that's what I'm up to. But a lot of people, they think that's too abstract, especially a lot of youngsters. What they're more interested in is hustling like crazy right now and then retiring early. Now, of course, sometimes it really doesn't necessarily mean to retire. It more means that they just want to be able to control their own schedule. Maybe it means working fewer months per year, fewer weeks per month, something like that. But regardless, this is a scaling back. And honestly, a lot of people who choose this as their motivation, they secretly think that everybody is trying to retire early. And I assure you, that's not the case. Like, some people are fueled by ambition. They want to buy their entire hometown. They want to go for that generational wealth and make sure that their great grandchildren never have to hold a day job. And to further that purpose, they're going to be hustling into their 90s. Maybe that's vilified in some circles, absolutely. But the fact is, you need people who are similarly motivated to keep at it if you're going to be successful in this industry. So they're great teammates. Just like the last group, but they're not so much concerned about their great grandchildren never having to hold a day job, but they have picked a sector of society, or maybe it's animals, maybe it's the environment. Who knows what it is, but they figured out that there's a financial component to making a big impact, and that's why they're making their commercial real estate acquisitions. So, Martin, I know that you're not typical for your age, but these 5 different motivations here, what combination of those would you say describes you best?
Yeah, it looks like for me, the best one is probably trade time for wealth. That's definitely the category I'd fall 80% into.
I love that answer. Exactly. You know, you definitely see what I see. And of course, it's pretty easy to get overly optimistic sounding, even to the point of naivete, when you're talking about these motivations. But one thing that you may have run into, if you've ever been involved in one of these 506B syndications, the fact is there's risks involved in every single business, especially real estate is a mature
Yeah.
industry, so there's lots of people who haven't got it quite figured out. But if you've ever been involved in a 506B deal, whoever the securities attorney in the mix was, they should have insisted that everybody fills out this questionnaire with these really invasive financial questions. If there was no securities attorney in the mix, then you should not just walk away, you should run. Okay, you have to get that exemption done. It's really bad news to be investing passively if you don't have all your T's crossed and your I's dotted. But the securities attorney should have asked everybody to fill out this questionnaire. It's sometimes called a suitability questionnaire. And when I was going through them, I found one question really lacked utility, and it was the tolerance for risk assessment question. I felt that any of the answers somebody could choose, that doesn't really give you a usable answer. So I made my own one, which is a fill in the blanks question. And it is, there are many popular investment asset classes, but I think blank is too risky. So, Martin, your answer can be inside real estate. It could be outside of real estate. What's something that people invest in where you're just like, I'm not touching that with a 10-foot pole. It's just too risky for me. What's too risky for you, Martin?
It looks like most cryptocurrency would fall into that category.
I love that answer, because after all, at the end of the day, it's just appreciation, right? Buy low, sell high, or lose, right? It's not like in commercial real estate where, you're getting some sort of cash flow in result for your investment dollars. So that's why I always love it when people say crypto. But let's get into some further details here. And one of the things that I avoided when I first started doing these chance encounter interviews was this slide right here, the favorite deal metrics. And the reason why I skipped it for the longest time is because I know that some people in this industry, they're more like the public relations side. They're not the people who are enjoying digging into those spreadsheets, finding out that upside, figuring out exactly how they're going to make this deal make more money. But I figured out that even though we have these people who are just on the PR side, the marketing side, or whatever, I find that everybody is going to pick some of the main metrics as the headliner to figure out if they're going to pursue a deal or not. And for anybody in the audience who is just listening and not watching, I read out all of these entries on this list of the different metrics. And of course, it's not an exhaustive list. Any repositioner or any underwriter would say it's like, okay, well, these are all important. You can't really play favorites. It's a balance of all of them. But here we go. We'll maybe pick a top three or something like that. They are cash on cash, IRR, cost per door, net operating income, which is also known as NOI, going in cap rate, which is really the difference between what you're buying at versus what's standard where the property is located. Then there's the loan interest rate, which is especially important if you're going to be assuming a loan. The occupancy, which is the inverse of vacancy. It's the same thing, occupancy and vacancy. Then there's the average income where the property is located. There's the amortization period of the loan, especially if you're going to be assuming it. There's the market versus in-place rents, so the difference between those two numbers. The population growth where the property is located, so you have some baked-in appreciation through demand right there. Then you have the sponsorship record, which is how many deals have gone full cycle, how many deals are on the go right now. I have the waterfall, the split or the exit strategy, which is what happens after your capital has been returned to you. Then I have DSCR, which is the debt service coverage ratio, which means how much of the revenue from rent is going out the door immediately just to the loans. So once again, I know that there are other metrics out there, so you're free to go outside of them. But Martin, what are the big ones that you hone in on first?
It looks like for me, the cash on cash return is probably number one.
Mm-hmm, mm-hmm. Excellent, excellent. And were there any others that you wanted to give specific attention to, or you just want to go off of that first one?
Uh, yeah, IRR and DSCR.
Okay, beautiful, beautiful. I love it. I'm eating that up like a delicious subscribe sandwich. It's a very subtle reminder there. Its subtlety is kind of my strong suit, but it tells me that it's time to bring out the Dan Does Deals Commercial Core Competency Cube with the 6 different roles in a commercial real estate deal. And I go through every single side in every single episode because, once again, my priority is to make sure that you learn how to more effectively communicate on the subject of commercial real estate deals. And I also want to make sure that you understand how my guest fits into those deals. And if you're looking at this cube and going, wow, I really need to get me one of those, the good news is it's absolutely free. You can go to dandoesdeals.com. There's this big conspicuous button. You can click on it and print it out. And I have to confess, I committed the cardinal sin of marketing, which is you should never ever give your freebie away without asking for some sort of contact information. So you should ask for like an email address or something like that. But I didn't do that because I want nothing in your way from printing this out and learning how to effectively communicate on these deals and be able to spot from a mile away. It's like, okay, that person's missing this piece of the puzzle, and that's why they are doomed for bankruptcy. But let's get started. Repositioners are the most visible people in a commercial real estate deal. They are the acquisitions people. You're more likely to meet them than anybody else. They're looking at a whole whack of different properties to find that diamond in the rough, and they're doing on a whole whack of paperwork to figure out if it's the right deal. The paperwork they're doing, it's often called underwriting the deal, and it's figuring out things like, is this property even making the amount of money that the seller slash broker claims it is? Because there's not really many guarantees of that. And then, of course, the thing that's most obvious about the peculiar nature of repositioners is that they have to have a vast network of financiers. The financiers themselves, they are people who only deal with paper and money. They are not dealing directly with the deal or with the residents or anything like that. So they are not going to be on the GP team. They're only going to be responsible for their piece of the puzzle of the loans themselves. And the reason why the repositioners are so key and headset, why they have to have such a vast network of financiers is because if the repositioner can secure a more advantageous loan, then that goes straight to the profitability of the building. That is why they have to have lots of financiers in their network and spend a lot of time with them. But of course, the next place a repositioner is going to look is going to be in operations to stop those Benjamins from going down the toilet. But of course, there's more to operations than just unclogging toilets and mowing lawns or shoveling snow. Me personally, I tend to contribute to my GP teams, my web-based application development, and the bigger one too. It really depends on you understanding that the enemy in real estate is vacancy. So even if you're like me and you like to focus on deals where it's 100 units or more, so the bigger side of these deals, you're probably going to be outsourcing your property management in that situation to a third party. And you have to be aware that if that property management company can't fill the units, somebody on the GP team is going to need some serious marketing chops and step in and get those units filled. So those are the things that I contribute to a GP team when I'm on them. But of course, a repositioner's next place to look is going to be getting a contractor team involved to do some upgrades to the property so it's a nicer place. And then residents would be more than happy to pay more in rent than the previous one, which is what some of that that upside that the repositioner is looking for in the first place. But if only it was that simple. The fact is, you can spend endless amounts of money on contractors. You can go ahead and gold plate the toilets if you choose to, but I don't think that you're going to get that return on your investment. That is for sure. So the thing that you can do, especially if you're like me, I don't know if you know this about me or not, but I'm from the internet. And that means I need locals. I need boots on the ground to keep an eye on the contractors and on the operations team, make sure that they're not dragging their heels, make sure that they're not using subadequate materials and whatnot. So the local is going to be there in an hour or two because I sure won't be. I'd still be stuck at an airport in an hour or two. So that's a key piece of the puzzle. But let's say that you become a repositioner. You get the idea in your head to take over a building down the street. Let's say it's 350 units and it's tens of millions of dollars, but you figure, hey, you're an attorney or a physician or an engineer, something like that. And you figure your friends and you can just, put down the deposit and borrow the rest and take over the property. Well, the problem with that little hypothetical is that when you turn around to the financiers, the banks, and ask for the loan, you say, hey, I want to buy that property over there for tens of millions of dollars. Do you have, say, I don't know, tens of millions of dollars that you want to lend us? Well, the financier is going to have one problem that I haven't mentioned. And if you're in a guru program or a mentorship program, I encourage you to listen very carefully to this next part. They're going to ask you, who's your sponsor? Who's your KP? What's that all about? In order to be eligible for a commercial loan, somebody has to already own a similar asset. So in other words, you need to be able to prove to the bank that you're not going to run the property into the ground and lose all the money from their depositors that they're lending to you. So they need to have that. And then on top of that, you need a certain amount of liquidity among the ownership team. And then as far as collateral goes, the GP team needs to sign and have a balance sheet of at least the amount of the loan. But if you've got all those pieces, you got yourself a commercial real estate deal. So Martin, I noticed that you dropped off briefly there and your camera is still off. As far as the 6 different roles on these deals, which roles in those do you expect to fill in your next deal?
Yeah, it looks like for me, I also do have a digital marketing
Yeah, you're
role.
super quiet and I can barely hear you. I'm going to pause it. Okay, and we got our audio back. So, which of the six sides are you going to most likely cover there, Martin?
Yeah, what was the first side you did?
First side's the repositioner, which everybody to some degree has to be a repositioner because you have to choose which deal is ideal and which one is you should pass on. But
Yeah, it looks like for me, because I also have a fair amount of digital marketing experience, that's the most likely thing that I would help with.
mhm. I love that answer. So then let's talk about the buy box then. When real estate people are asking, hey, what you're looking for, what's your ideal property, what's your buy box, we're really asking about three main things. First one's geography. Where is it? Which state, which county, possibly even which neighborhood? Okay, of course, some people are more dependent on their sponsors, their deal sponsors, and they're going to be somewhat agnostic to it, depending on those sponsors to make that choice for them. But really, the geography is still going to be important from an emotional level, if nothing else. The second one is size. And most of my guests on this show are in multifamily. And in multifamily, which is apartment complex investing, the way you define size is by the number of units, the number of apartment units. The idea being that that's how people are actually mitigating some of the risk of being involved in these deals. They're simply going and choosing to instead of depending on a single family rental where all the income comes from one single resident, you're actually dividing up your income among more of them. So that size is definitely going to matter. Other types of commercial real estate will go off of acreage or by square footage, but the reason why it's important to know what size is ideal for somebody is because the type of group that's going to take over 15 unit apartment complexes or smaller facilities, they're going to be fundamentally different from the ones who take over bigger deals like 150 units and more. So that's the size. Now, the third one is usually called class. I'm personally not a big fan of using the term class for it. I think desirability would be a much better term. The real reason why I don't like the word class is because it's two separate things. The first one is the condition, second one's area. If you're talking about condition, it's how old is the property as far as the building goes, how beat up is it, and then what sort of luxuries and amenities are there? Like, are there none at all, or is it a really fancy place in general? That's the condition. But when you're talking about area, especially if you're talking about multifamily, you're going to run into the school districts being very relevant as far as where that property is located. It'll increase the desirability because there's better schools. But regardless of the type of real estate that you're talking about, the crime rate is going to be very relevant. And then the other one, some people call it location, location, location. I'm not a fan of that trope. I think they really mean traffic, 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 because if a gazillion people are passing by a property every single day, it's automatically going to be more desirable than one where it's basically crickets all day long. But both the area and the condition, those two different versions of class or desirability, they're ranked the same way as in grade school, where you have A plus at the top, then it's A, then it's A minus, then it's B plus, and so on. So, Martin, as far as you and your organization goes, what's easier to say yes to?
Looks like for us, we're looking at 100 plus units, multifamily for the most part. In terms of the property, it would be B class assets in
Mm-hmm. Mm-hmm.
or C class assets in B neighborhoods, I think is probably the best way to put it.
Mm-hmm. Mm-hmm. Yep, I love that. And then what about the states? Which states are you really focused on?
Southeast, Southeast Sun Belt, Georgia, Texas, Arizona.
Mm-hmm. Mm-hmm. All right, great, great. Good stuff. So then let's talk about people. And honestly, it's my favorite part of commercial real estate. Unlike in tech and other things, sorry to poo-poo on, engineering and all that kind of stuff, but I don't think that we're the most social people in technology. Whereas when you're in commercial real estate, because it's multifaceted and it's not a bunch of people trying to do the exact same job, it's people hunkering down on their one or two roles, whatever they're really focusing on, and knocking that out of the park. And the result of it being multifaceted is that we all are so eager. We're eager, not eagle. We're eager to give referrals and introductions to build new teams, even if we're not going to be on them. But even though that's the case, we all have our own unique skill sets. it means we're going to be better off, better suited to help some people more than others. Me personally, because of my background in the technology, the content creation, all this attention getting nonsense, the sponsors and KPs usually have enough of a business foundation created where a person like me can make a disproportionately large difference. And of course, with the recent activities that I'm starting with the debt fund, with loaning, the sponsors are generally the ones who are going to be able to repay those loans and have the deal flow to make it happen. So I'm always eager to talk to them. And then, of course, at the end of the day, everybody is in the industry of deploying capital. So the financiers are also a pivotal part of my business, even though everybody I need to talk to in the context of these interviews, especially the locals, because I'm from the internet. But Martin, if you have any 506B deals, make sure you don't mention them specifically, especially as you're talking about a deal, a 506B deal. But who's in the audience that you are best suited to help?
Yeah, it looks like we mostly are connecting with people who are operators because we focus on the capital raising. But if it were a GP deal, then it would most likely be still operators, but also potentially some other capital raisers in that case.
I love that answer. So people must be thinking how to reach out. And I'm going to sandbag the conversation first by drawing attention to my very distinct last name. Makes me really easy to find on LinkedIn, which is the social media platform where I spend most of my time. Of course, if you check up Amazon.com, I've got a few books available that are on different business related skill building and different skill sets that you might want to do. But if you are going to be involved in investment or in syndications and taking on investors, I highly encourage you to pause the video. You can scan this QR code right here, which goes to the FAQs page of 506BME, which is the platform where we offer the service of maintaining and creating your documentation for your 506B substantive relationships. The idea is if your laptop falls into the bathtub, the SEC is still going to require that you have that documentation, that you can prove that you knew the person's appetite for risk, core competencies, and fun stuff like that before you started pitching your deal. And that way you are showing that you care and you don't want to wind up in an orange jumpsuit. But Martin, if people are interested in speaking to you, like social media, email, website, how should people reach out?
Yeah, it looks like the best thing is also LinkedIn, just my name, Martin. It's probably up here too, Kenny, Kenny.
Excellent. And so just, I imagine there's a few Martin Kennys. So where will it say that you're located so they know they got the right one?
Boston. Or
Out of Boston.
Singapore. So, yeah.
Okay, perfect. And then that brings me to the last part of this interview. It's the public service announcement. It's actually not for you, Martin. It's for you in the audience. If you've been watching this episode and experiencing like searing pains in your eyeballs and like migraine like symptoms, I'm confident it's because of the downright hideous subscribe button that's just down there, and you can get rid of it for free. Full disclosure, I want people to click on it because if enough people do, YouTube will actually start to pay for these videos instead of me. And I think that would be amazing. As far as the trade-offs to you, as I said, it doesn't cost you anything. All it means is my videos may show up on your list of suggestions. But quite frankly, you can go ahead and ignore those suggestions. I just appreciate the fact that you spent this time with me. Just like Martin, I appreciate you joining me. This has been great.
Thank you.
Awesome. Thanks. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506BME or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye. Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay. Are you already logged into 506BME?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506BME, everybody.